Let me ask Stan, even though, okay, go ahead, Stan.
Let me correct one thing, which is perhaps indicative of the confusion here. When I said there was a bond market rally, first of all, yields are irrelevant. The prices of bonds went up tremendously yesterday. That is to say, and it's the exact opposite of what you indicate. And that's as a result of all of these problems that you think are happening, and it's all the same bet. There's one bet in the U.S. and in the world economy. It's a sad bet, but it's an interesting bet, and that is, will the housing market in the United States stabilize or not? Every other bet that is made in the global economy, whether it's a minor Chinese marketplace, whether it's the Chinese yen carry trade, are all predicated on whether the housing market in the United States is going to stabilize. It's unfortunate because that happens to be the way the United States banking system is run. We have a huge housing market which differentiates the United States from any other country in the world. And that housing market, for the first time, may be going down. If it goes down, people are afraid that the U.S. economy, because of spillover contagion, will slow down, and then the driving engine of the entire world economic cycle may move lower. If that happens, interest rates in the United States are going to go lower, the dollar will be depreciated, and the carry trade will be taken off. And it's all one bet. Now, whether the right bet or not, that's the issue. However, let me put the risk is. And the risk is this. There are only two things in the world that people can buy. They can buy stocks or they can buy bonds. I'm assuming they own a house. And really, they can't get out of the risk they have in the system. However, of those two assets, one is very risky, the stock market, and the other one is not risky, the bond market. And what happens is that people, and particularly in the United States, where people are growing older and having to retire, they are beginning to shift their portfolios out of stocks into bonds. And when that happens, and particularly the American pension funds, as has already happened in Great Britain and in Holland, they are being forced legally to exit the stock market and to buy bonds because they have pensioners that are retiring and they have to meet those cash flows. And the risk in the marketplace is this, that if the stock market drops 10%, you cannot pay your pension fund.
Okay. Adrian, I saw you nodding your head there.
Well, it's interesting. I mean, there's a number of point of views that have been circulated. I agree with some of them and not all of them. I mean, obviously, the U.S. housing market is the big question mark. When will it go? But there's all sorts of other questions pending in the market having to do with, the deficits of the U.S. economy. And people have been saying for years that that's going to blow, too. So, I mean, until something actually does blow, this game could go on for quite some time. So there's not enough of an indication yet that the plug is going to be pulled on some of these factors that are out there. However, I just want to ask you something about the way you see it as a geopolitical play. I don't understand quite who stands to gain in what you describe concerning China. It seems like everybody has profited from the U.S. system of deficits and so on. So why would the Chinese be making a geopolitical move? That wasn't quite clear to me.
Well, a couple of points. First of all, as far as there being only two asset classes in consideration here, stocks or bonds, you're ignoring a huge third major asset class, which is commodities, in particular precious metals, gold and silver. Gold and silver obviously telegraphing inflation, pipeline inflation, coming down the road, and this is something to consider, and this is something that, again, these other economies, China, European economies, central banks are reversing their long-term standing positions of selling gold back to accumulating gold, and this is, in fact, the greatest, the world's fourth major currency is gold, and there's positions being built up in this currency, in the gold market, and in anticipation of an unwinding of these interest rate arbitrage spreads, these various carry trades that are talked about, and on the back of a declining housing market, which is stretched beyond its ability to sustain itself. Geopolitically, we live in a very volatile era, obviously. The U.S. administration is saber-rattling against Iran. Iran has a mutual defense pact with China and Russia, and this is going to become more of a factor going forward. And my point that I made at the top of the show is that we live in an era now where these financial contracts can be used as aggressive, almost weaponized futures contracts, not to put too dramatic a point on it. But
the Chinese investor is probably one of the most heavily invested investors in the U.S. markets. So, I mean, if he's going to provoke a crash of the U.S. markets, he's just cutting off his nose to spite his face.
Plus, the Chinese economy is hugely dependent on the U.S. economy.
Exactly.
So-
And let's get to
So
that.
I don't see the point in
What
it.
we're seeing in China is an emergence of a middle class for the first time. That China potentially can be self-sustaining without the American consumer to sustain itself.
Okay.
I disagree.
I'd like to you bring up something else, though, interesting. That's the fact of, the acquisition of U.S. assets by various countries in Asia. They are the primary owners of U.S. foreign debt by vast majority. It's 4 central banks in Asia that really own all U.S. foreign
Absolutely.
debt. So talk about the interest in that. What's at risk for Asia should the U.S. economy?
Yeah. No, I disagree with what's just been said. This may be a concern for 2020, but I doubt very much that this is a concern for 2007 or 2008. I think we're still. Things are much more basic than that. I think that the Chinese authorities were more concerned by the domestic scene and the fact that uneducated individual investors were heavily speculating, and that's what called for this warning signal, which put a bucket of cold water on the Shanghai stock market. But I don't believe that there's been a grand plan of geopolitic nature, especially because of what I said before, which is that for the time being, there's so much interest in terms of the real economy in China to have a strong U.S. and European economy that I doubt very much that they could have a plan.
Okay, I'm going to have to cut it off there. We need to take a break now. This is the end of the first half of this edition of the debate. We'll be back in 12 minutes' time after news and weather. Do stay with us for more on the state of the global economy when we return.